All right, today we're going to dive into one of investing's simplest, but also one of its most durable strategies. It's been around for decades, and it's all built on this one single idea that feels a little bit backward, bidding on the underdog.
It sounds completely wrong, doesn't it? I mean, all the conventional wisdom tells you to buy the winners, ride the momentum, and stay away from stocks that are struggling. But what if that's not the whole story? What if the most unloved, downtrodden blue-chip stocks actually hold the key to outperforming the market? That right there is the fascinating idea we're digging into today.
So this strategy has a pretty cool name, the dogs of the Dow. And the process itself is remarkably straightforward. At the beginning of every year, you look at the 30 huge companies in the Dow Jones Industrial Average. You find the 10 with the highest dividend yield. That's just the cash they pay out to you is a percentage of the stock's price. You buy those 10, put an equal amount of money in each, and then you just hold on for exactly 1 year. It's a system that's designed to take your gut feelings completely out of the equation.
Okay, so you might be thinking, is this just some kind of gimmick or is there some real substance here? Well, to figure that out, we've got to look at where this whole idea came from and the pretty powerful logic that's holding it all together.
Yeah, this idea is definitely not some new fad. The core concept actually has academic roots going all the way back to 1951, with research showing that buying big, cheap stocks can be a winning formula. The financial press started picking up on it in the 80s, but it was Michael O'Higgins who really made it famous in 1991, coining that memorable name, Dogs of the Dow.
So how do you actually do this? Well, it's real magic. Its power lies in how disciplined it is. It forces you to remove emotion from your decision-making, which, as pretty much any investor will tell you, is often our own worst enemy.
Okay, let's break it down step by step. At the very end of the year, you take that list of 30 Dow stocks and you rank them by their dividend yield. Simple. You grab the top 10, invest an equal chunk of money into each one, and then you do nothing. You just hold them for exactly 1 year. When that year is up, you do it all over again. Sell the stocks that aren't in the top 10 anymore and buy the new ones that are. That's it.
And this is what's absolutely crucial. The rules are rigid. They're set in stone, the selection date, when you rebalance, how you size your positions, it's all predefined. There is zero room for you to second guess or say, maybe I'll just hold this one a little longer. And that's the whole point.
All right, so we get how it's done, but the really interesting question is why? Why on earth would buying last year's laggards actually work over the long haul? Well, it all comes down to some really powerful ideas in both finance and, believe it or not, human psychology. It really boils down to 4 key ideas. First, market overreaction. We as humans tend to panic over bad news and sell stocks way too aggressively. Second is what's called blue chip resilience. These Dow companies are giants. They're built to last. Third is mean reversion. This is just the simple idea that things tend to return to their long-term average over time. And finally, there's that forced discipline we keep talking about, which stops you from making classic emotional mistakes. And here's the beautiful, simple math that makes the whole thing tick. A stock becomes a dog because its price has fallen. Now, since the dividend payout for these big companies is usually pretty stable, a lower price automatically jacks up the dividend yield. That high yield is basically a giant flashing sign that says, hey, over here, this quality company might be on sale.
Okay, enough with the theory. Let's make this real. Let's take a look at which companies actually made the cut for this year, 2026. This is where the strategy really comes to life. And here they are, the 2026 dogs of the Dow. I mean, look at this list. It's full of giants like Coca-Cola, Chevron, Procter & Gamble, and check out Verizon, leading the whole pack with a yield over 6%. These aren't some obscure, super risky companies. They're household names that have just fallen out of favor with Wall Street for one reason or another.
And if you look at the sectors, it really tells a story, doesn't it? A whopping 40% of this year's portfolio is in healthcare. What that suggests is that the market is feeling pretty pessimistic about that whole industry right now. So the dog strategy is basically making a bet that that pessimism is overdone and a recovery is probably on the horizon. And get this, to really put that yield into perspective, the average for this group of 10 stocks is about 3 times higher than the yield on the broader S&P 500. That gives you a really significant income stream, which can act as a nice cushion for your portfolio, especially if the market is flat or down. You're literally getting paid to wait for these underdogs to turn things around.
You want a perfect example of how this works? Look at Nike. It's a new name on the list for 2026. It's a global icon, a classic fallen champion. The brand has hit a rough patch, and that's caused its stock price to drop.
Well, that drop pushed its dividend yield just high enough to qualify it as a dog. An investment in Nike today is a pure bet that they can pull off a successful turnaround.
Okay, so buying a fallen hero like Nike, it feels right, doesn't it? It's classic value investing. But let's be real. No strategy is perfect. And to get the full picture, we have to look at both its historical strengths and some very, very valid modern criticisms.
On one hand, the strengths are pretty obvious. It's disciplined, it's simple, and it focuses you on value and income. But on the other hand, and this is a big one, you've got some serious weaknesses. The biggest is probably the tech gap. It almost always misses out on those high-growth tech companies that don't pay big dividends. There's also the risk of a value trap, which is when you buy a stock that looks cheap, but it's actually just in a permanent downward spiral. And, like we just saw, it can get you way too concentrated in just one or two sectors.
And you can really see this in action during the last big tech boom. From 2010 to 2019, the dogs actually underperformed the broader market. Now, a 13.5% annual return is nothing to sneeze at. It's solid. But it just goes to show you that in certain times, this value-first approach can definitely fall behind.
So that brings us to the big final question. In a world that is increasingly driven by fast-moving technology and huge growth companies that don't pay dividends, is the dogs of the Dow a timeless lesson in buying value when everyone else is scared? Or is it an outdated relic of a bygone era, just too slow and too narrow to keep up anymore? The answer probably depends on what the next decade of investing looks like, and that's something for every single one of us to think about.